But if you don't own assets and you're getting paid in cash, then your value is decreasing. Your relative value is decreasing. So labor has wages, not many assets. They get screwed by a falling dollar. Capital class, maybe they have wages, maybe they don't, but a lot of the wealth is tied up in assets. They actually benefit from a falling dollar. So this wealth divide, the capital labor divide that we've talked about from an AI perspective, now gets even further accentuated by the de-dollarization that's going on. And so I think that again, what should you do? You got to get out of cash.
Hello and welcome to Being Exponential with Luke Lango, where we'll cover the economy, the markets, technology, and lifestyle, all from an exponential perspective. I'm your host, Brooke. It is Wednesday, January 28th. Let's dive right in. All right, Luke, it looks like you are in Phoenix. Unfortunately, I am on the East Coast where we just had a snowstorm. I checked my weather app this morning. It said 9 degrees. I'm miserable, man. How are you?
But just let me have my flowers, okay? This is the one time a year that Phoenix gets to brag about its weather, okay? January,
Mhm.
February, March. This is when we get to brag. Just we won't talk about May or June or
Right.
July or August or September. Maybe we can talk about October. But once November rolls around, I'm here for you. Let's have a conversation about weather. So let me have my flowers, please, and thank you.
Sure. Of course, man. I don't
How
know.
how
Right
how
now,
was
I
the
think
storm? How are you holding up in the storm?
I'm doing all right. The heat's still working, but I think as I'm living in it, I'd rather take 108 than 8 degrees. Personally, I don't know.
That's what I've always thought. I mean, I'm sad I said goodbye to San Diego. You know how that goes. I wanted a dog, or I didn't want a dog. My wife wanted a dog, and so we compromised and got a
You
dog.
got it.
Well,
Yep,
that's how
yep,
we
yep,
ended up
yep.
in Phoenix. So I had to say goodbye to my wonderful San Diego, where it is always between 60 and 80 and very temperate and not a lot of humidity and just wonderful all year round. But yeah, I would rather take the extreme hot than the extreme cold. I am with you on that. I am not made for extreme cold. There is not enough blubber on me to to keep me warm in the extreme cold.
Yeah, man, no bueno. All right, let's talk about somewhere that's cold more often than it is over here. Let's talk about that Greenland deal. So last week, funnily enough, at the very end of the recording of our episode, they announced Trump and Greenland announced they worked out a framework for the deal. Greenland still maintains sovereignty, but the U.S. has almost carte blanche access to materials, rare earths, or things they were invested in or interested in. Yeah, give us an update from your perspective on the Greenland deal, Luke.
Kind of just a non-event, really. Like I'm glad it happened. We got it over with. Now that drama's in the rearview mirror. I think there's going to be a lot of legal stuff going forward in terms of I guess Greenland wasn't even involved in the deal. So people of Greenland get a say here.
Yeah, right.
So there's going to be a lot of back and forth. It's not a done deal. It's not resolved by any means. But the worst case outcomes, the two worst case outcomes have been averted. The first one was use of force. That was averted with the comments early last week when Trump said we will not be using force. And then the second worst case outcome was this barrage of tariffs between both the US and the EU. The US slaps tariffs on, the EU comes back with tariffs, or they start dumping treasuries. So kind of financial war. So hot war averted, financial war averted, worst case outcomes averted. It's not a done
Right.
deal, but because we've averted the worst case outcomes, I think the market, well, it has bounced back and it will continue to bounce back. I think it's just in the rearview mirror. Fun fact before I'll let you jump in here is the Bloomberg Economics did a study on all the Trump tariff threats that have been thrown out over the last, well, actually since
Okay.
he won in November of 2024. Only 20%, one out of five, of those tariff threats have been fully imposed. So that's why the market, I think, is going to continue to brush off all of these tariff threats because the track record is only 20% of threats become actual action. And so from that perspective, as long as that remains true, I think the market will, be just fine in the face of what will likely be more tariff threats, right? We just threw a 100% tariff threat on Canada, I think, for a potential deal with China. And the market just kind of shrugged and ignored it.
Gotcha. Now, something I want to talk about kind of ties into the next three topics here, next two topics here, right? So I want to get into gold, silvers, metals, and essentially the deflation of the dollar. However, kind of tying it back to Greenland, American policy has been pretty extroverted over the past month or so, and foreign entities have maybe perceived this as American destabilization in their policy, right? So
Yeah.
we're seeing threats of selling of bonds, essentially divesting from America. I've heard it called the "Sell America" narrative, right? So, do you see that as being a larger issue going forward?
Listen, we are in a regime of structural de-dollarization.
Right.
Um, Central banks, foreign investors, governments across the world, they own a lot of US dollars, they own a lot of US debt. And I think they are trying to get rid of that. I think they're trying to
Hmm.
dump that. There's a few reasons for that. One is, yes, as America becomes increasingly isolated, that's a reason to dump dollars and dump debt because it's isolationist now. It's not connected. We're not all in this together. We're not one big happy family. We are a disparate family. So I think that's one big reason. Another big reason is Trump wants to run it hot. He wants to run it really, 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 really hot. When you look at kind of the spending that's happening, we have the Greenland stuff. That's going to cost a lot of money. If we go up there and we start mining stuff out of the ice fields, we build more military bases. That it's not free. It's going to cost a lot of money to do those things. Venezuela, you want to rebuild that oil empire? That's going to cost a lot of money. Defense budget, you want to up that from 1 trillion to 1.5 trillion? That's an additional $500 billion dollars in spending. So, a lot of government spending. Trump wants to run it hot. So, okay, that's another reason to dump the dollar because the dollar becomes worth less in a era where we're just kind of printing money and spending money like crazy. And then the third is Fed independence. That Trump has attacked the Fed multiple times. We all know that whoever he puts in there, Kevin or Rick, apparently Rick Ryder's the new favorite.
Hmm.
Whoever he puts in there is gonna do one thing, and that's cut rates a lot. You're probably going to get 4 to 5 cuts in the 4 to 5 meetings after that chair is implemented or is put in power. So that's a lot of cutting, and the market doesn't really need that cutting right now. The inflation numbers are at 2.7, and because commodities are rallying, that means higher inflation, right? If you look at Bloomberg's commodity index, excluding gold, because gold's not really an input to inflation. If you
Right.
look at the commodity index excluding gold, it's breaking out to the upside. That index has been a very good leading indicator of inflation in the US economy for a very, very long time. So the fact that it's now breaking out to the upside means CPI at 2.7 right now probably heads towards 3, 3.1, 3.2 over the next few months. That's not a place where the Fed really needs to be cutting rates. So if we get aggressive rate cutting against that backdrop, it creates concerns about running it too hot, about excessive accommodation, about excessive money printing, about excessive growth, and that will also lead to de-dollarization. So I think we are getting structural global de-dollarization. Cash is trash, or dollars are becoming more and more worthless. And so you are seeing people, investors, trade in their dollars for hard assets like gold, like silver, like copper, and they're moving down the chain: platinum, palladium, aluminum, tin, rare earths, all this stuff, germanium, all this stuff is catching a massive bid because of two things: the de-dollarization trend we just talked about, but that de-dollarization trend is also converging on an AI super cycle, which is creating a resource super cycle. You throw up one of those data centers, it's got a lot of silver in it. It's got a lot of aluminum in it. It's got a lot of tin in it. There's a lot of rare earths in it. And so you build all of these data centers, you create massive resource demand. At the same time, a bunch of money is leaving the dollar. So you have this infinite money chasing limited or finite supply, and that creates a crunch. It creates a supply crunch, and that's how you get these massive moves higher in the metals and the hard assets. And I think that continues.
For sure. Yeah. So a question on two fronts regarding these metals, right? So we see gold just skyrocketed past 5,000, silver just over $100 an ounce, and all
Mhm.
the other metals that you mentioned are on the rise, right? Um, Now, in terms of those assets by themselves, have we missed the boat? You're saying that they're going
No.
to continue,
Yeah,
and then
no, they're going to continue. I think they're going to be on a big run. Now, I'm not a chaser. I don't like to chase, so I'm not saying go and chase silver at 120.
Mhm.
But what I would say is buying on pullbacks. Absolutely buying on pullbacks. I think silver probably goes to 150 or 200. I think gold actually has a chance to go up to 10,000. Like I think these are real targets that could be hit within the next 12 to 24 months. And given that, I would be a buyer on pullbacks. When you look at the metals complex, whether it's gold, whether it's silver, whether it's copper, whether it's aluminum, whether it's nickel, platinum, palladium, these metals are susceptible to frequent, depending on the metal, 5 to 15% pullbacks.
Mhm.
Silver tends to do a 5 to 10% pullback every few months. Copper, a little bit bigger. Platinum and palladium, you can get up to 15% pullbacks there. But these metals are susceptible to regular 5 to 15% pullbacks. We're obviously not in one of those 5 to 15% pullbacks right now. But on the next one is when I would load up. When everyone's like, this trade is done, here's the top, that's when I would come in and load up. You can load up on the ETFs, SLV, PPLT, PALL, that's silver, platinum, and palladium. GLD for gold, or you can get into the miners complex, right? Miners are a great high octane way to play this if you're looking for more alpha, more supercharge, more turbo there. But I do think the metals rally is here to stay. And
Gotcha.
within the metals universe, my favorites are copper and lithium. That I think copper is the most necessary in building AI data centers. And therefore, when we talk about this infinite money converging on finite resources, the supply crunch will likely be largest, in my opinion, in copper. So I think copper is one of the better ones to play. It also hasn't run up as much as your gold or your silver. And then the other one I would say is lithium because lithium, not as much in AI data centers, but you know me, huge believer in physical AI, huge believer in AI coming to devices, whether it's AI glasses or humanoid robots or self driving cars. All those devices need better batteries. They need more lithium. They need better lithium architectures. And so I think lithium demand is going to surge. So I'm looking for the metals where, as this infinite money supply converges on the finite resources, supply will be most constrained by AI demand drivers. And I think that's true for pretty much the entire metals complex X gold, but I think it's most true for copper and lithium, not to mention those ones haven't run up as much again as the gold and silver headline complex.
100%. Gotcha. Yeah, yeah. So like you're saying, these metals don't exist in a vacuum. They are being used for resources. Like
Mhm.
you mentioned, silver being
Outside of
used.
gold's the only one
Right.
that does kind of exist in a vacuum. That's more of a independence risk thing. I think that one just goes because of the other factors we talked about. The
Of
rest
course.
of the stack is benefiting from AI demand drivers too.
Now, are there, out of curiosity, my question there is, are there any other sector? I know certain industries like solar are being affected with headwinds because of the soaring prices in silvers. Are there any sectors we could be looking at that are going to get tailwinds because of the raise in metals prices?
Um, Not that I could think of off the top of my head. Like higher metal prices it's actually gonna be like a headwind for construction and stuff because it's more expensive
Across the
now
board.
to
Yeah,
upgrade, right? Because the big bull thesis on silver for AI is that you want to upgrade the copper cables to silver cables because it's the best conductor out there. But silver
right.
is super expensive, and the more expensive silver gets relative to copper, the less attractive that upgrade looks from an economics perspective. So, if anything, it creates kind of headwinds for other sectors. And it creates headwinds for inflation or tailwinds for inflation. It'll push inflation higher if all these metals keep pushing higher. Because, again, to your point, they are used in the real world quite abundantly, especially copper.
Gotcha, gotcha. Now, talking about inflation and deflation once again. So the index that tracks the dollar, it indicates that it's at its lowest in the past 4 years. It's dropped
Hmm.
10% in the last 12 months.
Hmm.
Do you have any more insight on this? What say the average investor should be doing right now to prevent the deflation from affecting their savings, their portfolio?
Yeah, get the hell out of cash. I mean, that's what everybody else is doing. Get the hell out of cash. Cash is trash. Like everyone's been saying cash is trash for a while, but cash isn't actually trash now. If you have savings accounts, you have checking. I mean, checking accounts different. You have a savings account, whatever. You need to get that stuff in assets. You need to get it in gold. You need to get it in silver. You need to get in metals. You need to get into stocks. You need to get into real estate. You need to get into something because what dollar devaluation does is it increases the price of everything else priced in dollars. Because I mean, it's math, numerator, denominator, right? If the denominator gets less valuable, then the whole thing gets more valuable, even if the numerator doesn't increase, right? So everything is priced per dollars. And so if dollar goes down in value, all other assets outside of dollars themselves get more valuable. So what to do when you see, Dixie, the dollar index down at a 4-year low, and you're right, down 11% over the last 12 months now, actually down 11%. That's one of the 5 largest declines this century. So we're in a dollar collapse, really, and that I don't think it's going to slow down. I really don't. I just look at the actions happening, the geopolitical chessboard, everything that's going on. Yeah, the dollar is going to continue to lose value, and so you have to get out of cash. You have to be invested. You have to own assets. It's an asset revolution, and it gets back to the stuff that we've been talking about on this podcast forever, which is the capital labor divide, right? A
Yeah.
falling dollar is actually great for the capital class because it creates asset inflation. And so if you own assets, you get quote unquote richer. But if you don't own assets and you're getting paid in cash, then your value is decreasing. Your relative value is decreasing. So labor has wages, not many assets. They get screwed by a falling dollar. Capital class, maybe they have wages, maybe they don't, but a lot of the wealth is tied up in assets. They actually benefit from a falling dollar. So this wealth divide, the capital labor divide that we've talked about from an AI perspective, now gets even further accentuated by the de-dollarization that's going on. And so I think that again, what should you do? You got to get out of cash. Cash is just losing its value. So yeah, that's kind of my take on it all.
Yeah, 100%. And with rising inflation, it's just this compound threat to the regular citizen, it sounds like.
Well, yeah, because then the falling dollar increases inflation even further. And then the thing is like, yes, wages will adjust, but it takes time for wages to adjust. Assets adjust overnight. Dollar falls 2%, stocks go up 2%, right? Like that's an overnight adjustment. Your wages are not an overnight adjustment. People get reassessed, probably annually. Most jobs get reassessed annually for raises and bonuses and stuff like that. So it's another 12 months before your wages reflect that. And even then, historical studies show that, your wages don't all of a sudden massively get bigger if the dollar goes lower. What happens is it takes 5 or 6 years for that to be fully
Mhm.
reflected into wages. So there's this gap here between the wage reassessment due to the falling dollar and an asset price reassessment due to the falling dollar, where asset prices reassess instantaneously and wages take 5 to 6 years. So cash is trash. Again, get into assets, and metals are having their day in the sun. I think they'll continue to do really well in 2026. But I come back to AI still the North Star. AI stocks are still they're the best bet on Wall Street. They're the best game in town. You look at, we're in the earnings season right now. You look at what's being reported. I mean, today we got Seagate, ASML, F5, GE Vernova, Corning, SK Hynix from South Korea, Texas Instruments. They're all great reports. I mean, we're getting double beaten raises across the board, strong guidances, revenues up 22% for Seagate, record backlog at ASML, $15.3 billion. I mean, these are fantastic numbers. The AI spending boom remains vigorous, and you're seeing AI stocks respond in kind. Look at the memory stocks. Seagate, with those big results, goes up 20%, lifts the whole memory complex. Western Digital, SanDisk, Micron, Rambus, the whole complex goes up because of that. So I think we're going to get really good AI earnings over the next few weeks. I think AI stocks are going to blast higher. So metals, cool, love it. Get that diversity in your portfolio, but AI stocks remain the North Star. AI stocks remain the best game in town. If you really want to get ahead, that's where you are going to get ahead, or going to have the best chance to get ahead.
Yeah, 100% agreed. Pivoting back to AI stock specifically, I wanted to dive down into the niche. The big news that came out recently is Nvidia taking a $2 billion stake in a CoreWeave specifically. Now that just kind of projects the future of AI scaling. However, there were some current concerns about it being another circular financing deal. What are your thoughts on that particular deal, Luke?
Yeah, so that complex is not going to fail.
Right.
Um, there were a lot of fears about CoreWeave failing. Super levered, a lot of cash burn. They need more money. Well, Nvidia said, sign a check. Here's your more money. You need it. Here, take it. Take it. So I think that removes a lot of the financial risk for CoreWeave. I think it's a high octane stock. We talked about CoreWeave specifically. Um, I like that one here. We're clearly on a U-turn in the chart. It looks pretty good. It's making a comeback. It's now in a new uptrend, staging higher highs and higher lows. They have the money now. That was the big risk, was the cash risk, and now they have the cash, a lot of cash. But more than that, the investment kind of signals that Nvidia is going to support them no matter what. Right. I mean, if you look at the spreads on CoreWeave, the odds of bankruptcy in the bond market were really, really, really high. That Nvidia had all reason not to give them more money, yet they still gave them more money. So I think that not only does this mean, yes, they have the cash now to continue to grow for the next year or two, but if there is a cash crunch in the future, Nvidia probably steps in again. This is something they clearly are showing with their actions they want to support to fruition or to the end point. So I think CoreWeave stock is great here. I really do. I think that one's ready to bounce back in a pretty big way. And if you kind of look through, there's follow through on the other stocks, on the other neocloud operators, APLD, Applied Digital, IREN, Nebius. These ones are starting to come back. APLD's had a really big breakout. IREN looks really good here too. So I think that neocloud space where there were all these risks about financing and leverage and all that crap, I think that those are now over. I think those risks have blown over, and now those stocks are ready to rebound like crazy. They're high octane stocks that will get a big bid here. Zooming out, bigger picture, the Nvidia investment is coupled with the news that OpenAI is raising a crap ton of money. And that's part of that whole circular financing deal, right? It was OpenAI and Nvidia are kind of the two big pillars of that big circular financing chart that Bloomberg sent out a couple months ago. Well, there have also been fears that OpenAI is losing the AI race and that they're going to go belly up. I've seen some pretty bold predictions out there that OpenAI is going to go bankrupt this year, or that they're going to fail and it's going to blow up the whole AI complex. No, 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 no. Ha, 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 ha. Hardy, har, 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 har. Right? Like, that's not happening because OpenAI just raised $40 billion from SoftBank here in 2025, or last year in 2025. Reports just broke that SoftBank, Masa's son, wants to pour in another $30 billion into OpenAI this year. So that's $70 billion that they got from SoftBank. And let's move forward to the middle of this year and let's say that deal closes. So they got $70 billion from SoftBank, $40 billion in 2025, $30 billion in the first half of 26. Then OpenAI, Sam Altman's off in the Middle East trying to raise $50 billion from sovereign wealth funds from those big Middle East investors over there. And reports broke that Nvidia wants in on this round. Microsoft wants in on this round. Amazon wants in on this round. Everybody not named Alphabet wants in on this round. So you get that $70 billion from SoftBank, you get this $50 billion from that other raise. It's $120 billion. Their most recent projections as of September 2025, the latest reporting, was they're going to burn $115 billion through 2029, at which point they will become self-sustaining and profitable. Well, $120 billion raise, not coincidentally, is bigger than the $115 billion projected cash burn. So what you are seeing is a collective effort to keep OpenAI alive to fight Alphabet. Because I think what you are seeing is NVIDIA is looking at this, okay?
Mhm.
And they're really worried about the custom silicon complex, which is being led by who? Alphabet and their TPUs. So they don't want Alphabet to win the AI race, because if Alphabet wins the AI race, then their TPUs antiquate NVIDIA GPUs, and NVIDIA no longer has a business. So NVIDIA has a very huge incentive to not have Alphabet win the AI race. Who's the next biggest competitor? OpenAI, who uses NVIDIA GPUs, okay? So NVIDIA has a huge vetted interest in keeping OpenAI alive and afloat. So does Amazon. So does Microsoft. Microsoft is their biggest investor. Amazon doesn't want Alphabet to win, right? Big tech doesn't want another big tech competitor to win the AI race. They'd rather have a non-big tech competitor that is sort of platform agnostic win the race. So Microsoft has a vetted interest. Amazon has a vetted interest. I wouldn't be surprised if you see Meta commit some money in here because they have a vetted interest as well. So you are seeing this huge collective effort from the world's most powerful companies to not let Alphabet just run away with the AI race. It doesn't mean OpenAI is going to win. It doesn't mean Alphabet's going to win. All it means is the race is still on and there is no guaranteed winner. It means we're going to have a really close battle over the next several years with the two exchanging punches. And I think the death of OpenAI calls are completely overdone. And it's related to Nvidia's investment in Coreweave and Nvidia now trying to take a play in the OpenAI round.
100%. If I remember correctly, Meta was making a couple of deals with Google and with Alphabet in terms of purchasing
Yeah, so
chips.
Meta's the one big tech company that's not rumored to be involved in this new OpenAI round. So maybe they are trying to tie themselves closer to the Alphabet ship. I don't
Right.
really know. Um, but what I do know is that Nvidia getting involved in the OpenAI round is a pretty big deal because it
Yeah.
shows that they're worried about the custom silicon complex, and it shows that they want to fight back against that. And the way they fight back against that is making the OpenAI models better and allowing OpenAI to continue to grow.
Yeah.
So there's just so much money behind OpenAI that the deaths of OpenAI calls are pretty wild to me and wildly inaccurate. And I think that the whole Nvidia complex, OpenAI complex, can stage a rebound. I like Gemini better right now. I think Gemini is better than ChatGPT. I use it more,
Yeah.
but given all this money that's now coming into OpenAI, and I love Sam Altman as an executor, that combination tells me that they're going to land some pretty big punches in 2026. So if you have ChatGPT, don't cancel it. Keep using it because I think they're going to have some big model updates that blow the current Gemini out of the water. Then Gemini will come back and blow them out of the water. And it's going to go boom, 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 boom. And we're going to monkey branch and climb up the ladder until finally somebody wins. But again, we're in the third mile of a marathon. A
Right.
lot of race left.
Yeah, the $1 trillion like IPO evaluation for OpenAI is seeming more and more likely. I noticed a couple weeks ago they started to distribute ads on I think the free version of ChatGPT. Do you
Mhm.
see that as a cause for concern, or is that just another method of getting profit, getting revenue into the system?
Yeah, I mean, it's just them being smart about it. It's just them saying, hey, we are burning a lot of money. We do want to be smart about it. So let's try and get some ads in there, right? Because that's the big thing with
Right.
Alphabet is they don't need to raise money because they have a massive ad business that's subsidizing their AI business. So it's just like, hey, yeah, here's let's try and do that too. And so I think I don't really take too much of it. Some people are like, oh, it's such a desperate move. No, it's just a smart move. It's a rational
Yeah.
move. I think it does have a hint of desperation on it, but it's smart too. So I think that yeah, I don't view that significantly in either direction.
Gotcha, 100%. Okay, so let's pivot in another direction. Still within that AI umbrella, technically, I want to talk about the U.S. government taking a 10% stake in USAR. That's the state-backed capitalism we've been talking about for the past couple of months. What's your take on that particular deal, Luke?
In who? You mean USAR, the company that we said they were going to take a stake in next?
Right, right, right. Yeah, it
That
is ringing
one?
some bells. Yeah,
That
yeah.
one? Yeah, I mean that the writing was on the wall for that, and we called them. We told our subscribers to get in on that, and boom! I mean that stock went from 10 to 30, and now it's right around 25. But um, yeah, I mean, do you want to let's talk micro first, and then we'll talk
Sure.
macro.
Yeah, yeah.
Micro. The deal is big for rare earth stocks because let's talk about USAR. It gives them the money they need to really accelerate development of that round top project in Texas, the mining operation in Texas. They'll get that up and running within 2 years. It accelerates and should expand the capabilities of their Stillwater manufacturing plant in Oklahoma. That one should really be at some major capacity this year, by the end of this year, and definitely going into next year. So it gives USAR the money they need to become a true mind magnet U.S. rare earths titan. So I think
Mhm.
it's super bullish for USAR. Not to mention, why are we going up to Greenland? Because of the rare earths. Who's
Exactly.
going to mine those rare earths? Who's going to process them and turn them into magnets? USAR and MP. So it's great news for USAR. I think that's a great stock long term, especially now that the US is involved there. $1.6 billion cash infusion plus $1.3 billion in debt financing, 10% stake. Pretty good deal. So, like USAR a lot. MP, I think, is the more interesting play here because it dipped on the news, presumably on this idea that MP is no longer the only child, right? Like MP was the one national champion, carry the flag
Mhm.
bearer of the U.S. rare earths industry, and now they got to share the spotlight. They got to share the throne with USAR. And so some investors are like, "Oh, I don't like that. Sell MP stock." I say buy that dip because I'd rather be a duopoly of a very, 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 very large U.S. rare earths industry than a monopoly in a not so large U.S. rare earths industry. The government's not going to let either MP or USAR fail. The fact that they doubled up here, invested in two companies, means they have a real big commitment to making the U.S. rare earths industry very, 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 very large. I think MP is in a great position for that. Not to mention, MP is ahead of USAR in terms of development on all things, not just the mining, but also the manufacturing. So I think that MP is a great buy on that dip. That's the micro implications of what's going on here. Buy rare earth stocks, a lot of support there, a lot of involvement, a lot of growth potential. The macro is that free market capitalism is freaking dead. That's the
Right.
macro. We have fully pivoted into a technological republic where the private and public sectors, the technology private sector and the public sector, are teaming up to accelerate what they view is in the best interest of America. It is not the free market deciding. It is not the invisible hand. It is the iron fist. That's what we have. That's the macro here. We've told you that this was happening, right? As soon as the US government, the Pentagon, invested in MP back in July, I believe, of 2025, our first
Mhm.
read through was free market capitalism is dead. Like, this is not just a one off, and it has not been a one off. There's been a series of investments and deals since then to again swap out the invisible hand for an iron fist. And what that tells me is that you want to bet alongside the White House. You want to bet alongside the Pentagon. You want to bet alongside the US government because it is the biggest, most powerful, deepest pocket investor in the world. And they are still making bets. They are still making investments. Interestingly enough, they're doubling up. A lot of people didn't think they would go for USAR because they had already selected MP. But they said, nah, we want more rare earths. Doubled up on rare earths, got USAR. So now let's look at what else they've invested in. Chips, chip manufacturing in the US, Intel.
And
Probably going to double up. They're probably going to double up. That's why we like GFS, Global Foundries. We think that's their double up play in chip manufacturing in the US. Lithium Americas, lithium, probably going to double up. Is it Albemarle, ALB? Is it like what is it going to be? Um, we'll see. So I think that what you want to do is you want to look at what they have invested in already and understand that they probably want to double up on a lot of those things. They really want the things they've invested in, they really believe in, and they want to double up and find other players to help grow those respective industries. So I think that that's a playbook that'll work really well in 2026. One of the things we've talked about is Trump's going all out. He's going absolutely all out. And this is an all out blitz that you can probably make a lot of money in if you align yourself correctly. I mean, look at MP. It went from 20 to 60 pretty much in a matter of 2 months or so. USAR went from 10 to 30 in a matter of a month. These are 3x gains in 1 to 2 months. That's what's possible in some of these other plays that I think are followed up by it. What's interesting is the government has not yet made a play in nuclear, really. I think they're overdue for a play in nuclear. Oklo is probably going to be their play there because Energy Secretary Chris Wright, he used to be at Oklo. He used to be involved with Oklo, and
I got my fingers crossed on that one.
and that's one that could really, I mean, that could go gangbusters with that because what they're investing in outside of Intel, if you look at kind of the materials plays, the resource plays, they're investing in startups that need
Mm.
money to succeed. They're startups with big visions and big potential and lots of assets, but they're not businesses yet. They're not revenue generating, cash flow positive businesses yet. What they need to get there to become titans is money, and the government is giving them that money. Oklo fits that description perfectly. Big potential, big vision, all the right people. All they need is a big old cash infusion to execute on that vision, and boom, you got yourself a U.S. nuclear titan. Why wouldn't the government want that? I think they sure as hell do. So that, in my view, is probably next as well. So that's my big read through, my micro, my macro read through on read throughs rather on the implications of the government taking a stake in USAR.
Definitely. Yeah. It seems like that A in USA is going to become United States of angel investing, right?
Yeah, it's that's funny. I had not heard of that. I mean, again, for a different podcast, but there are a lot of arguments to be had about the pros and cons of becoming a technological republic.
Mhm.
Right now, my job is to just acknowledge that we have entered that era. And so you gotta adjust. You gotta adapt. Love it or hate it, you gotta adapt. Same with the de-dollarization. You can love it if you're in the capital class. You can hate it if you're in the labor class. I don't care. You gotta adapt. You gotta adjust. That's the same thing with the end of free market capitalism, the beginning of the technological republic. That we've crossed the Rubicon, and there's some going back if a Democrat wins in 2028, and then you got to adjust to whatever the hell that regime is. But for right now, at least over the next 10 months for sure, there is clear line of sight to this technological republic growing in influence, growing in scope, and therefore having bigger and farther reaching implications throughout the market.
100%. Yeah, yeah. We're kind of just watching the waters here, like you mentioned. You did talk about USAR prior, so at the heart of this podcast, it's informing our viewers on how to move in this essentially new world order. Now, I don't think we have any questions for today. Do you have anything else you would like to touch on, Luke, that we might not have talked about today?
Um, I think that again, I think the de-dollarization is a massive thing that people need to pay attention to. You have to own assets. And then I think that you have to own the right assets because not only are we getting a divide between labor and capital in the economy, and therefore you have to join the capital class and own assets, but even within the asset class, you're getting a divide between the AI sphere of influence and everything else. Um, we've been dumping in our model portfolios a lot of these everything else bets that we thought, oh, they're pretty attractive. Maybe they can make comebacks. Valuation is nice. Nike, Starbucks, Lululemon. These are great companies that make great products. I'm a consumer of them. I love Lulu. This is Lululemon, I think, or I don't know. Something I'm wearing is Lululemon. I love Lululemon. I love Starbucks. The pistachio latte they're running right now is delicious. Nike makes great basketball shoes and a lot of great other stuff, but these stocks just are not working because of the divide between AI and everything else. And I think that's best evidenced by the recent Conference Board January Consumer Confidence Report.
Right.
Miserable. Now, I have a colleague because the University of Michigan consumer sentiment has been rolling over like crazy. Like rolling over like crazy. That is for several months been all time low, all time low, all time low, all time low. Consumers hate the economy. That the read through on that one has been very clear for a long time. The consumer is getting destroyed. A lot of pundits like to argue that that survey is political, that it's University of Michigan. It actually surveys along political lines. Or, what do you think about it if you're Republican, if you're Democrat, if you're independent, la di do. So there is an argument to be had. Not saying I agree with it, but there's an argument to be had. The University of Michigan Consumer Sentiment Survey is political. But the people making that argument have long said the one you got to follow is the Conference Board. That's not political. That is a non-political survey. That's what the people arguing against the University of Michigan survey are saying. Well, now that one's rolling over. Now that one's at a 12-year low. So, I mean, there's like, it's either way you slice it, no matter which way you look at it, the consumer is getting destroyed, or at least they think they're getting destroyed. Perception is not reality. We know that, but the perception among consumers, regardless of the University of Michigan or conference board, or you just talk to your damn neighbor, is that yeah, things aren't great for the consumer right now, for the labor market right now. That's where the particular weakness is in the labor market. Another example of this: UPS, they're firing people, stock goes up. Amazon, they're firing people, stock goes up. ASML, they're firing people, stock goes up. Like this is crazy. It's front and center. The division between labor and capital. Labor class keeps losing job cuts, job cuts, job cuts, job cuts. And what are those? Why are they doing those job cuts? To get more money to increase their AI spending budget. And then they spend more money on AI. What's that going to do? Well, it's going to lead to more job cuts because you get more automation. We're in a spiral. We've talked about chaos economics before, currency hollowing and over automation spiral, CHAOS. That's what we're in. The devaluing of the currency, labor class is getting destroyed, cash is trash, but capital is winning. Then you get over automation where they're firing to get more money get more money for AI to build better AI, which is going to lead to more automation and more firing. It's a loop. So we're in this chaos spiral, this currency hollowing and over automation spiral, and so you got to leave the labor class. You got to get out of cash. You got to own assets, and you got to own the right assets, which is the AI sphere of influence. Even the metals, to your our point earlier, that's in the AI sphere of influence. Outside of gold, which is unique unto itself, all those are under the AI sphere of influence. So that's my impassioned final takeaway, I guess, from this week's podcast. And I am so passionate about it because I think it's very real that a lot of people like to get on podcasts or TikToks or Instagrams and state hyperbole week after week after week after week, and none of it comes true. And we're kind of tone deaf to hyperbole now as consumers of media and content. This is not hyperbole. What's going on with the dollar, what's going on with automation, what's going on with the split between labor and capital, between consumer sentiment surveys, regardless of which one you look at, and stock market prices. This is real, it is big, and it is important, and you need to be paying attention, and that is why I'm passionate about it.
Yeah, I love it, man. As the old saying goes, men lie, women lie, but numbers don't. And it just seems like the writing's on the wall. We say that here time and time again. You have to become a capitalist, essentially. You have to own assets, otherwise you'll lose the long term battle there.
Especially with the dollar going down, which is the latest wrinkle that is significant to that. Because
Yeah,
one could say the labor class was stagnating if the dollar is going up. But if the dollar is going down, doing nothing in labor means you are losing. You're actively losing every day. So that's concern. And then if they do cut rates, right? Let's
mhm.
say they do cut rates dramatically, that means your savings yield is going to go down, right? So now your savings yield is what, like maybe going to be 1% or 0.75%, however much they cut, right? So you're only getting 1% per year on your assets and savings, and then the dollar is going down. We said it's down 11% over the last 12 months. So let's just say that continues. Let's call it 10%. So you're up 1 on your yield, and then you're down 10 on the dollar. So you're minus 9. And then you have inflation, maybe a 3 or 4. So maybe you're minus 13, 14, wherever the hell you're going to land there. You're going to lose minus 13 every year just by sitting in labor. That's the problem. That's the big problem right now. So that's why you have to get in assets, and that's why you have to get in the right assets. Because even just assets, the S&P 500, let's say it goes up 10%. That's its average annual return, right? 10%. If everything in dollar terms, real value is minus 13, and you're up 10 on SPX, then you're down 4 on net real terms. So you got to get into the right stocks. You can't just get into the market, right? So this is all, there's a lot of nuances to it, but the takeaway is pretty simple. Get out of cash and get into the right assets.
Exactly. Yeah. Can't agree more. I mean, I'm doing it. I've gotten into a couple of the positions we've talked about on here. I hope the listeners are as well. Just taking advantage of the information and making sure you're not left behind as things change. I love the passion there, Luke. I love the sentiment. It is a bit sour. It is a bit, harrowing, but it needs to be heard. And I think that's a great place to end this particular episode. We will be back next week. Make sure to comment, subscribe, like, all the things. And we will make sure to discuss everything next week. Take care.